Do you want to make money in the market? It's super easy, but at the same time, it's super hard. Once we get to the end of this video, you'll know why. So with that said, let's get right into it. 10 steps to optimizing your investment portfolio for maximum growth. First, starting with what we shouldn't do. Step 1 to optimizing your investment portfolio for maximum growth. Don't invest in individual stocks. Let me be blunt here. Most people can't pick winning stocks, and that includes you and I. Many people think they can because of shows like Mad Money, Reddit forums, and financial articles like 5 best stocks to buy now. And because of these media platforms, many come to believe that one can really play the stock market, and with enough reading and enough research, one can make money in picking stocks. However, you have to understand that these media content are not there to help you make money in the market. It's actually the opposite. Many of these media companies' entire business model is based on convincing people that they can pick winning stocks. CEOs come on to discuss why viewers or listeners should invest in their companies. Analysts appear reinforcing their recommendations. And convinced by their cover of professionalism, we as individual investors come to believe these expert analysis of individual stocks. We think we understand a company and how it will perform in the future, thus going out and buying or selling individual stocks. The honest truth is that these media outlets don't care if you make money or lose money in the market. All they care about is their ratings and audience retention. Ratings bring in ad revenue. And do you know who most often are buying these ad slots? Companies that want to sell you financial products. Banks, investment management companies, trading platforms. No one in the media knows the stock's future because they don't care about accuracy. All they care about is getting your attention. And if they can make you believe that you can win trading stocks, that's what they'll constantly do. So be wise and don't fall for their tactics. Stay far away as possible from individual stock picking. Step 2 to optimizing your investment portfolio for maximum growth. Don't invest your money with professional money managers. Funds that are managed by professional money managers are called actively managed mutual funds, as opposed to index funds, which are passively managed essentially by a computer. And they are one of the most financially profitable products in the industry. So much so that there are literally more mutual funds than individual stocks. According to a US News and World Report, there are about 4,600 equity mutual funds operating in the US. Do you know how many total publicly traded companies there are in the US? Slightly over 4,000. Give and take. There are essentially more packaging of the goods rather than the goods themselves. But what is even sadder is the fact that very few of these actively managed mutual funds beat the index over time. In 2013, Vanguard studied over 1,500 actively managed equity funds over a 15-year period and found that 82% of the funds failed to outperform a simple index. But actively managed mutual funds will never advertise they have a horrible track record. Instead, they just close the underperforming ones and launch new funds to entice new investors. When there's a lot of money to be made, especially for the investment firms, don't be surprised how far they'll go to keep their highly profitable investment products selling. Bottom line, if you want to optimize your portfolio for maximum growth, stay away from actively managed mutual funds. The theme of always looking for ways to save money, let's talk about our phone bills. If you're tired of paying too much for wireless phone service, you might want to consider Mint Mobile, who I'm partnering with for today's video. And just in case you were wondering, yes, it is that phone company owned by Ryan Reynolds. Mint Mobile offers premium wireless for as low as $15 a month, and all plans include unlimited nationwide talk and text, plus super fast 5G and free mobile hotspot. And switching to Mint Mobile is quite easy. Thanks to their digital SIM cards, once you sign up, the whole process to switch will only take about 15 minutes. Mint Mobile is able to keep costs low because their business model is based on direct online selling. With no need to maintain costly retail stores and salespeople, they're able to pass those savings directly to you, the customers. You know how much I love efficiency. If you want to start saving money on your phone bill today, use my link, trymintmobile.com/financialtortoise, or scan my QR code, and you'll get a 50% discount on the unlimited plan. It's not only a great way to save money on recurring expenses, but an easy way to support this channel as well. Alright, with that said, let's get back to the video. Step 3 to optimizing your investment portfolio for maximum growth. Don't try timing the market. The concept of buy low and sell high seems simplistic enough. And many of us, whether we like to admit it or not, do it all the time. We all look at the market, and we all have an opinion about where the market is. Oh, the market is too high. Yes, we're at a dip. And there's a lot of appeal to the notion of stepping out when the market is high and back in when the market is low. But the reality is that it's almost impossible to do. Many of us who try to time the market are oftentimes buying high and selling low, panicking when the times are tough and buying when the market is soaring. Regardless of how special we think we are, most people follow the herd mentality. When the news is filled with doom and gloom, most people can't help themselves but sell because they're afraid of what they own is going to fall further. And when the news is filled with glitz and hope for the future, people buy and artificially drive up the market even more. Trying to time the market is a hopeless goal. Seriously, if a group of people were running in hysteria, how many of us would have the calmness of mind to stop and ask, Why are they running? We'd run first and ask questions later. It takes awareness and intentional effort to counter this natural human tendency. So bottom line, don't try to time the market. All right, with what we shouldn't do out of the way, let's get into the nitty-gritty of what we should do to really optimize our investment portfolios. Step 4 to optimizing your investment portfolio for maximum growth. Invest with simplicity in mind. When it comes to investing in the market, the proliferation of choices can make our heads spin. Should we buy individual stocks, ETFs, index funds, or mutual funds? Should we favor one investment strategy or try to mix and match? Growth, value, 3 fund, 6 fund, 10 fund, or the rainbow portfolio? And how should we divide our money between domestic and foreign stocks, bonds, cash, alternatives such as private equity, REITs, gold, and Barbie doll futures?
Do you guys ever think about dying?
The financial industry doesn't make it easy for us. And that is most often because simple does not make money in the investing world. Complex makes them money. Of course, at the expense of individual investors like you and I. The favor of complexity was what led to the mind-boggling innovations such as collateralized debt obligations, structured investment vehicles, and credit default swaps, all which came close to destroying the global economy in 2008. Jack Bogle, who founded the Vanguard Group in 1975 and who created the first index fund, the S&P 500 Index Fund, stated in his book titled Enough. Financial institutions have a large incentive to favor the complex and costly over the simple and cheap. Quite the opposite of what most investors need and out to want. Don't believe that a complex investment portfolio or a complex approach to managing your money is there to help you make money. Most often, they're constructed to take your money. Alright, with the theme of simplicity in mind, let's get into the next step to optimizing our investment portfolio. Step 5 to optimize your investment portfolio for maximum growth. Invest in simple index fund as your core wealth building tool. Index investing in a nutshell is this. Instead of hiring an expert or spending a lot of your brain bandwidth trying to select the right stocks or actively manage mutual funds, you just invest in a good low-cost index fund like the Vanguard Total Stock Market Index Fund, also known as VTSIX, and you essentially forget about it. An index fund attempts to match the return of the segment of the market that is indexing. An S&P 500 index fund follows the 500 largest publicly traded companies in the United States. A total stock market index fund follows all the publicly traded companies in the United States. A total international index replicates a broad cross-section of thousands of reputable international stocks. With a small management fee for each fund, usually at or under 0.1%, you can be invested in an index fund within minutes. And indexing, in many experts' opinion, is really one of the best ways to invest because they have and will continue to outperform the thousands of actively managed mutual funds over a long period of time. They don't rely on a fund manager to select winning stocks. They don't have a bunch of unnecessary expenses that bogs it down. And they are one of the most diversified investments you can hold. Don't try to find the next Netflix or Tesla. Buy them all through a well-diversified index fund. Don't look for the needle in the haystack, just buy the haystack. If you want to deep dive into index funds, I'll have a link in the description below to a video where I talk about the reasons why I personally invest a good chunk of my money into index funds. Step 6 to optimize your investment portfolio for maximum growth. Minimize expenses. Lower expenses as much as possible. This probably is the most significant drag on most people's investment returns. The direct impact and the cost of financial services industry. It's not uncommon to see people paying 1 to 2 and sometimes even 3% of their assets to fund managers. 1, 2, or 3% may not sound like much on surface, but when we put this in dollar amounts, in a $10,000 portfolio, we're talking about $100 to $300 going into someone else's pocket instead of yours. And when we compound this over many years, we could be talking about thousands, if not tens of thousands of dollars. When we can reduce these fees, it translates to a direct boost to investment returns. Now, what is the most straightforward ways to cut fees? The most obvious way is to reduce the expense ratio that we're paying for our investments. A fee charged by the investment firm to manage the fund for you. Let's say that you have a stable investment portfolio of about $1 million, and you've been paying 2% expense ratio. $20,000 annually because it's being managed by a fund manager. Again, in my book, unjustifiable, given most actively managed funds fail to beat the market anyways. But if you fire your fund manager and learn to be your own financial advisor, you can drastically cut this expense. For example, my personal favorite index fund is the Vanguard Total Stock Market Index Fund, also known as VTSIX, has an expense ratio of 0.04%. When I invest $1 million with VTSIX, I'm paying $400 in expenses annually. Now compare that with $20,000 that you were paying earlier. Just by taking charge of your money, you're saving $19,600 a year. Money that is staying with your investment, compounding and growing your net worth instead of funding your financial advisor's yacht. Step 7 to optimize your investment portfolio for maximum growth. Minimize taxes. Another common drag on returns on top of investment fees are the effects of taxes. Income tax we pay to take money home, and capital gains tax we pay when we sell appreciated assets. And one of the best and simplest ways to reduce this tax drag is to invest in tax advantage retirement accounts, such as 401k, Roth IRA, defined benefits plan, and health savings account, aka HSA. When you invest in these accounts, your money is sheltered from tax. With the traditional 401k, you make contributions with pre-tax dollars, so you get a tax break upfront, helping you to lower your current income tax bill. Your money, both the contributions and potential earnings, grow tax deferred until you withdraw it. With a Roth IRA, though you pay taxes upfront, all the money invested grows tax-free, and withdrawals are tax-free in retirement. Less money to the government translates directly to increasing returns. If you'd like to learn more about the optimal order to invest in these accounts, I'll have a link to my video, Optimal Order of Investing, in the description below. Step 8 to optimize your investment portfolio for maximum growth. Always be buying. Whatever you can afford, whenever you can afford it. In the end, how your investment behave is much less important than how you behave. In Vanguard's 2012 research, they looked at the difference between dollar cost averaging and lump sum investing by assessing different stock to bond allocation in 3 different countries: the United States, the United Kingdom, and Australia. Dollar cost averaging, also known as DCA, is a phrase that refers to investing regular amounts over time. Lump sum investing, on the other hand, is when you take all your available dollars to invest and put it right into the stock market. The study looked at the rolling 10-year periods from 1926 to 2011. They found that at the end of the 10-year period, the lump sum investment led to greater portfolio value approximately 2/3 of the time. Even when the results were adjusted for a higher volatility of stock to bond allocation versus cash investments, this result was consistent across all 3 markets. The study's recommendation was this: invest the lump sum immediately to gain exposure to the market as soon as possible. Because the market normally goes up, investing early produces higher returns in most situations. So get your dollar to work as soon as possible. If you have money available, always be buying, regardless of how the market is doing. If you can get more dollars in the market as soon as possible, you're optimizing opportunities for maximum growth. It's not about timing the market, but about time in the market. Step 9 to optimize your investment portfolio for maximum growth. You want to take full advantage of the market growth potential? Take more risk by dialing up the stock allocation. Of course, only to the extent that you feel comfortable with the volatility. It's very important to understand that risk and returns go hand in hand. The higher the expected return, the higher the expected risk. So if we want greater returns in our portfolio, we must get comfortable with greater risk. And our stock to bond allocation is a mechanism to control that risk level. Vanguard research shows the average annual return and the worst single year return for various stock to bond allocation from 1926 to 2021. Let's say that we won 100% in stocks, assuming the most risky asset allocation we can. The average annual return will be 12.3%. But in our worst year, we would have lost 43.1% of our portfolio. This means if we had $100,000 in our portfolio, in a single year, we could see our portfolio lose up to $43,000 in value. This could be hard to swallow for many people, especially if you're expecting to pull some of that money out soon. So let's say we decide to go 100% in bonds, assuming the least risky asset allocation we can. In our worst year, we would have only lost 8.1% of our portfolio, which is much better than the 43% from our 100% stock portfolio. However, our average annual return is only 6.3%. Half of what we would have gotten compared to the 100% stock portfolio. We took less risk by going with 100% in bonds, but we also got less returns. If you want to give your investment portfolio the best chance for maximum growth, you want to dial up your risk tolerance and hold more stocks in your portfolio, regardless of how volatile it might make your investing journey. Step 10 to optimize your investment portfolio for maximum growth. Play the long game. The worst delusion that any investor can get him or herself into is the get-rich-quick mentality. I mean, why do we constantly have these bubbles? It was cryptocurrency and NFTs recently. A decade ago, it was the housing market. And a decade before that, it was the dot-com craze. We dial it back hundreds of years, and at one point, people were going crazy over tulips, having delusional thoughts that they can get rich overnight. The promise that you can double or triple your money in 1 or 2 years, in all frankness, is quite ridiculous. Like building a great career or a healthy marriage, successful investing requires time and patience. When it comes to wise investing, don't measure your time horizon in months or even years. Look at it for decades. That's why I personally don't think an investment's monthly performance or even an annual performance really matters. What matters is a long-term prospect, the potential growth of American and global companies. If you invest $100,000 in an index fund with an average rate of return of 8% and hold it for 30 years without ever touching it, you will eventually accumulate a portfolio of over $1 million. It's not a get-rich-quick scheme. It is slow and steady, and frankly, quite boring. But it is one of the most effective ways for regular individuals like you and I to accumulate wealth, and at the end of the day, that's what matters. Thank you guys for watching. In the theme of investing, if you want to know some of the best index funds to invest in the market, please check out my video here. Until next time, all the best.